After studying this module, you shall be able to know the meaning of financial management, identify the recent developments in financial management. To begin with, financial management as a subject itself is of recent origin. Earlier, it was considered as part of economics, and financial managers were called upon only when some critical financial activities were undertaken in any organization. But now onwards, the role of financial manager is of much more importance, and his support and services are required even in day-to-day activities like working capital management, managing cash, investment in marketable securities whenever there is a surplus cash, and liquidate those investments in times of need, etc. Financial management can be defined either in the broader sense as encompassing all financial activities, including from procuring of finance to its effective utilization, and also distribution of dividends and even budgeting. In the narrower sense, it will be synonymous to accounting, but it shall be a folly to restrict financial management in the narrower sense, and therefore financial functions include all aspects like management of finance. Even tax planning is part of financial management. However, financial management is a very evolving subject, and there are so many changes in the field, and it is important to keep oneself abreast with the latest techniques and tools that have been developed in the field. This module aims to discuss some of the latest changes and their impact. A good finance manager must be aware of all changes and updated in the field. Sometimes the sources of the funds are also new, and new options come on the way. Earlier, when finance was required, only option used to be within the country, but now international avenues are also open. Following are the main changing scenario of financial management in India. First major change in financial management in India is the change in interest rates. Second change that Indian markets have witnessed is the way the shares are valued. Third change is the change in the way business is being conducted, as now there can be takeovers or mergers. First major change in financial management in India is the change in interest rates. Recent developments in financial management that affects the ways finance is managed includes the way interest rates are determined in India. The impact of international market has impact on Indian interest rates as well. Earlier, the sources of funds used to be only within the nation, but now the funds are also available from international market. Therefore, there is a global impact on the interest rates. Second change that Indian markets have witnessed is the way the shares are valued. While raising the finance by issue of shares, pricing has now varied. The price of the shares can be ascertained by book building process. Earlier, the shares were issued at a fixed price, and the determination of the price, if it goes wrong, could lead to failure of issue. But now price band can be given. Value of shares now can be determined at higher or lower band freely. But shares should be valued at optimum level, because under and over subscription both will decrease the EPS. Third change is the change in the way business is being conducted, as now there can be takeovers or mergers. As a good finance manager, one should keep a whistle on the target companies with which mergers and acquisitions can be effected. There is an immense change in this scenario, as nowadays is a time of mergers and takeovers. In India, we have witnessed that Tatas have taken over the chorus. There is also a trend to take over those companies which have huge losses, so as to take the benefit of tax shield on accumulated losses. Another change that is witnessed is the way working capital is managed. Working capital management is the management of current assets and current liabilities. Working capital management is always very important aspect of financial management, and there is a very strong relationship between working capital and profitability. Nowadays, every company wants to earn higher return on the working capital than the cost it has incurred. Instead of relying on accounting profits, the performance of a company is judged on EVA. EVA means economic value added. It is the estimated profit which will be in excess of capital cost of all stakeholders. Another important aspect of working capital management is the management of inventory, and there is also recent development for providing solution of economic lot scheduling problem. If the best solution of ELSP is worked up, the inventory can be managed. The management of JIT system of inventory developed by the Japanese is also a development in inventory management. But value chain analysis is of recent origin, which is broader in concept than the JIT system. There have been two approaches developed recently in inventory management. One is the zero switch constraint, that is, the production of a part is started only when the entire inventory is depleted, and the second approach is equal lot constraint, that is, the lot size shall remain constant at any point of time. Debtor management has improved considerably. Credit rating is a recent development in this regard. Earlier, when goods were sold on credit, getting information about the creditworthiness of prospective customers was a costly and time-consuming process. It resulted in taking more risk, but now there are independent credit rating agencies, and debtors management can be more effective by using the services of these agencies. The RBI is licensed 4 credit score institutes. All these institutes records the credit history of each company. Name of these institutions are the Credit Information Bureau of India Limited, Experian, Equifax, and Highmark. A very important part of financial analysis is the ratio analysis. It reflects and speaks about the performance of an enterprise and very useful for stakeholders while dealing with the enterprise. The various ratios reveal different information, and these ratios also change over a period of time. And there is addition to the list of various ratios. Recently, many new ratios have been developed by experts. Some of the new ratios are discussed as under: Uncovered Capital Ratio, UCR; Foreign Currency Risk Ratio; Yield on Liquidity and Investment Ratio. Uncovered Capital Ratio is calculated by obtaining the portfolio at risk within bracket par greater than 30 days minus impairment loss allowance divided by total capital. The foreign currency risk ratio measures the relationship between net foreign currency assets and equity for each foreign currency on the balance sheet. Net foreign currency assets divided by equity for each foreign currency. Yield on liquidity and investment ratio indicates the level of returns an institution is generating from its cash holdings and investments averaged over a given period. Sometimes developments are not very apparent. They need to be discovered. While taking investment decisions from the financial perspective, a lot of techniques are employed to evaluate a project. These techniques are known as capital budgeting techniques. There are lots of new techniques that have been developed for evaluation of any project before undertaking it. Earlier, net present value criteria or internal rate of return. But now, many techniques like real option valuation model, etc. have also come up. Real option means to choose the best option regarding any decision. For example, if we buy a car and we use it for some time, then it is required to be replaced. The decision that is required to be taken is whether to replace the car or continue using it, or if we decide to replace, whether to replace after using it for 1 year or 2 years or more. Similarly, if one is drilling for well and there is no success yet, then to find out what is the best option, whether to continue drilling in the hope of finding results or to abandon the site. Real option valuation and analysis means to choose best option. So we find the ROV through capital budgeting and other methods. Capital structure means the proportion of debt and equity that should be employed in the total capital of the enterprise. One can use the impact of leverage to generate higher returns. Now, arbitrage is possible in any capital structure. Arbitrator can take the price advantages if there is different prices of company's equity or debt. Enterprises are seeking new sources of finance as it is a proven fact that the lower the cost of capital, the more the returns and more economic value added. In fact, the retaining earnings have also become a very good source of capital. Microfinance is the provision of a wide range of financial services, including saving accounts to the poor. Microcredit is a part of microfinance and involves the extension of very small loans within bracket microloans to impoverished borrowers, often with the goal of supporting entrepreneurship and or alleviating poverty. Peer-to-peer lending over the internet is another growing development in the financial sector, to which the principles of microcredit have also been applied in attempting to address poverty as well as various non-poverty related issues. Such efforts includes crowdfunding, a term describing the collective effort of individuals who network and pool their resources to support charities initiated by other people or organizations. The rules for crowdfunding are still being developed, and the Security Exchange Commission has yet to set the rules in place for equity crowdfunding campaigns involving unaccredited investors for private companies. The banking sector has shown a drastic change. Earlier, the main services provided by banks were only the lending and accepting deposits. But now banks provide multiple services like insurance, consultancy, advisory, portfolio management, etc. Global crisis that fueled strict regulation. New role of SEBI. The financial crisis of 2007-2008 caused the collapse of many large financial institutions, the bailout of banks by national governments, and downturns in stock markets around the world. Several major institutions failed. They were then acquired under duress or they were subject to government takeovers. These included Lehman Brothers, Citigroup, Fannie Mae, and Freddie Mac, among several others. The crisis rapidly developed and spread into global economic shock, resulting in a number of European bank failures, economic crisis in Iceland, declines in various stock indices, and large reductions in market value of equities and commodities. A currency crisis followed, with investors transferring vast capital resources into stronger currencies. The United States faced subprime crisis. The crisis played a significant role in the failure of key businesses, declines in consumer wealth, prolonged unemployment, and a downturn in economic activity in the United States. It also led to a global recession and a sovereign debt crisis in Europe. The analysis of this failure and crisis led many to believe that the regulatory framework could not keep pace with the innovations in the financial markets, and therefore a need was felt for increase in the regulation and its enforcement. Various regulatory reforms have been passed in the United States, and European regulators introduced Basel III regulations for banks. In India too, the role of SEBI as a regulator grew. The Indian regulatory and supervisory framework of securities market has been adequately strengthened through the legislative and administrative measures in the recent past. It is consistent with the best international benchmarks, such as standards prescribed by International Organization of Securities Commissions (IOSCO). The following are the recent capital market reforms. Extensive capital market reforms were undertaken in the 90s. The Securities and Exchange Board of India, the statutory market regulator, was created in 1992. SEBI was empowered to regulate the collective investment schemes and plantation schemes through an amendment in 1999. In the year 2000, an amendment in SEBI Act gave it the powers of search and seizure to make the body more powerful. Dematerialization started in 1997 after the legal foundations for electronic bookkeeping were provided, and now most of the trading is done in dematerialized form only. Till 2001, India was the only sophisticated market having account period settlement alongside the derivatives products. From middle of 2001, uniform rolling settlement and same settlement cycles were prescribed, creating a true spot market. The advent of derivative trading was a very recent methodology of doing business, and our legal framework provided for derivatives trading by the amendment of SCRA in 1999. Derivatives trading started in a gradual manner with stock index futures in June 2000. Later on, options and single stock futures were introduced in 2000-2001. And now, India's derivative markets turnover is more than the cash market, and India is one of the largest single stock futures market in the world. India's risk management systems have also been very modern and effective. The VR-based margining system was introduced in mid-2001, and the risk management systems have withstood huge volatility experienced in May 2003 and May 2004. This included real-time exposure monitoring, disablement of broker terminals, VR-based margining, etc. India is one of the few countries to have started the screen-based trading of government securities in January 2003. In June 2003, the interest rate futures contracts on the screen-based trading platform were introduced. India is amongst the few countries that have started straight-through processing (STP). ST will completely automate the process of order flow and clearing and settlement on the stock exchanges. RBI introduced the Real-Time Gross Settlement System (RTGS) in 2004 on experimental basis. RTGS allows real delivery versus payment. It is the international norm and is also recognized by BIS and IOSCO. The SEBI board, in its meeting held on 25th October 2007, had agreed to the creation of a separate exchange for the SMEs. On November 9, 2009, SEBI board took a decision on the operational aspects of the exchanges, platforms of stock exchanges for small and medium enterprises. Accordingly, SEBI has permitted setting up of a stock exchange oblique a trading platform for SMEs by a recognized stock exchange having nationwide trading terminals and also issued guidelines for market making for the specified securities listed on the SME exchange. Other important amendments to the SEBI: Issue of Capital and Disclosure Requirements Regulations 2009, SEBI Merchant Bankers Regulation 1992, SEBI Foreign Institutional Investor Regulation 1995, SEBI Venture Capital Funds Regulations 1996, SEBI Substantial Acquisition of Shares and Takeovers Regulations 1997, and SEBI Stock Brokers and Sub-Brokers Regulations 1992 have also been made. SEBI has made it compulsory for companies coming out with IPOs of equity shares to get their IPOs graded by at least one credit rating agency registered with SEBI from May 1, 2007. Since January 11, 2008, SEBI has also allowed trading on options contract on indices and stocks with a longer life tenor of up to 5 years. These contracts are expected to provide liquidity at the longer end of the market. Since January 15, 2008, SEBI has permitted introduction of volatility index on futures and options contracts. SEBI has set up the Investor Protection and Education Fund within bracket IPEF with the purpose of investor education and related activities. SEBI has contributed a sum of rupees 10 crores towards the initial corpus of the IPEF from the SEBI General Fund. To summarize, financial management as a subject itself is of recent to reason. However, financial management is a very evolving subject and there are so many changes in the field. And it is important to keep oneself abreast with the latest techniques and tools that have been developed in the field. First major change in financial management in India is the change in interest rates. Second change that Indian markets have witnessed is the way we value the shares. Third change is the change in the way business is being conducted, as now there can be mergers. Fourth change is in the tools used in financial analysis. Fifth, recent changes in capital budgeting and project planning. Sixth, another important change and development that has occurred is in the capital structure. 7. Change in new sources of finance. 8. Changes in the role of banks. The financial crisis of 2007-2008 caused the collapse of many large financial institutions. The bailout of banks by national governments and downturns in stock market around the world. Various regulatory reforms have been passed in the United States and European regulators introduced Basel III regulations for banks. In India too, the role of SEBI as a regulator grew. The Indian regulatory and supervisory framework of securities market has been adequately strengthened through the legislative and administrative measures in the recent past. Extensive capital market reforms were undertaken in the 90s. The Securities and Exchange Board of India, the statutory market regulator, was created in 1992.